So, hello everyone. Hello, I'm Daniel. I would like, first of all, to give a special shout out to everyone that is joining us tonight in this challenging times. I would like to say on behalf of BTG Pactual Digital that we are in this together. So that's why the team is been working hard to put up this very comprehensive agenda in the couple last months to bring up information, views, outlooks, and insights. So in times like this, in unprecedented times like this, the most precious asset that we can have is good information. So thank you very much for joining us this evening. I must confess that I'm very excited here to moderate such experts, such remarkable speakers here, two actually international guests that I would like to introduce right now. So Anatole Kaletsky, founding partner and chief economist at Gavekal. Andrew Batson, research director of China, and the most special expert on China that I follow, especially in times like this. And João Scandiuzzi, our global strategist at BTG Pactual Wealth Management. Guys, thank you very much for having the time, for making this possible. What we expect here is to have a living room conversation and debate on what's going on with the global market, what to expect going forward. I will start with Anatole. So Anatole, roughly 1 month ago, we were watching a huge sell-off and markets making the lows, roughly 1 month ago, approximately probably March 23rd. So 30 days from that point, markets are already rallying pretty much. And I don't know, the way I see it, like two big forces are playing out here. On the one hand, we are witnessing an unprecedented economic collapse. On the other hand, we are also facing unprecedented monetary and fiscal stimulus. How do you think these two forces will continue to play out on asset prices going forward? And if you could, and if I may, could you please set up the framework as in short-term, medium-term, and long-term in what to expect from asset prices? Again, Anatole, thank you very much.
Well, as you said, Daniel, we're in a situation where everything is unprecedented. So we can't really go back through history and past experience to guide us on this. And the way I look at it is that you have to view what is going on with all the intrinsic unpredictabilities of it, as you said, with a framework of 3 different time horizons. You've got to think separately about what is likely to happen in the markets in the short term, say the next 2 or 3 months, then separately about the medium term of the next 1 or 2 or 3 years. And then finally, I think there is a long-term perspective, which isn't really all that relevant to short-term trading or even to kind of asset allocation today, but which we have to keep at the back of our minds. And the reason we have to think about these 3 different time horizons is that, as you said, we're in a situation of unprecedented collapse combined with unprecedented liquidity creation and even more unprecedented fiscal stimulus. And this reminds me of, children, at least in English, small children always ask their parents, they say, Daddy, what happens when you get an irresistible force and it hits an immovable object? And there's no answer for that, of course, but the answer is there is no such thing in nature as an irresistible force or an immovable object. There's, even an atom bomb can't move the Earth. So the question is, which of these two factors is going to end up being more powerful? And I think it depends very much on the time horizon that you're looking at. So the way I see it is that the markets have rebounded very strongly from a month ago, as you said. But I think that is still a bear market rally, and it's a rally that should be faded, that you have to be a contrarian in the short term, because over the next 2 or 3 months, the data, both from the real economies all over the world, but even more from the financial results, especially the affected sectors, is going to be much worse than anybody has seen in their lifetimes. Now, you might say, oh yeah, but that's all expected. Everybody knows the GDP is going to fall by 20% year on year or whatever it is, and corporate profits will be down. But when this data actually comes through, and it has not come through for the first quarter, it's the second quarter that is going to be the really bad quarter, I think it certainly has the capacity to shock investors out of what is actually now a remarkably confident situation. If you look at something like retail investor sentiment, I've got a slide here that I'd like to show you. If you just show the first slide in my deck, it's page 2. You look at the bull-bear spread in investor sentiment, and what we find is that even at the low point of this collapse, investor sentiment was less negative than in any of the previous 3 bear markets, in 2008 for sure, but even in 2001 and even in 1991. And actually, it was less negative even than in the 4 corrections that we've seen over the last 10 years. So the investor sentiment is not negative enough. In addition to that, history shows that every bear market over the last 50 years, since 1950, with only one exception, you've had a bottom that is retested. So the idea that we see a bottom on March 20th, and after that you have a 25-30% rally, and the market will never fall back to anywhere near that bottom, I think is unrealistic. Now, it's unrealistic particularly because if we consider the data that is coming in, even with lockdowns end, everybody is focusing on the coronavirus data, which is sort of stabilizing. But the end of the lockdowns will not mean the end of the economic problems. There is going to be a big change in behavior, not just consumer behavior, but even more corporate behavior, with layoffs. Sorry, the slide is just coming. Yeah, this is the slide that I was referring to. You see those 4 arrows. They point to the corrections in the bull market in 2019, 2016, 2013 with the taper tantrum, and 2010. Each time investor sentiment was more negative than it is now. So I think the lockdowns are not the end of the story. The economic and financial results from the second quarter are going to be the climax of the story. And even though markets look ahead, I think they're going to be shocked. So why are investors apparently so bullish? And this brings me to the second time horizon. And this is when we look at 2000. This is the chart that shows that bottoms are always retested in equity bear markets. Now, then we move to the second time horizon, which is, say, from the beginning of next year, 2001, 2021, 2022, maybe. At that point, that is the point when I think the irresistible force of the monetary and fiscal expansion will turn out, or could turn out, to be more powerful than the immovable object of the economic collapse. So my philosophy of economics is basically a Keynesian philosophy, that demand, at least in the short to medium term, is more important than supply, the demand side. So if you push in enough demand, enough incomes into the economy, you will get growth. So I think there's a 50 to 60% chance that this enormous fiscal stimulus that we see next year will be effective and will pull most of the world economy out of recession. The US certainly, China certainly, probably Europe. Now, emerging markets we'll come back to in a minute. But the fiscal stimulus will work in my view, as a completely unreformed Keynesian, in my view, there's a, say, 50–60% chance that the fiscal stimulus will work. But the markets are behaving as if there's 100% chance that fiscal stimulus will work. And we will not know until the first quarter of 2021. If the fiscal stimulus does work, at that point, I think we should get, or shot somewhat before that point, we should get a very strong rally in risk assets. The reason for that is that once we get some kind of return to economic normality in most of the world, and corporate profits start to stabilize, at least even if before they start to increase, the interest rates that are used to discount those corporate profits are going to be much lower, not just than they have ever been in history, but much lower than anybody imagined possible as recently as 2 or 3 months ago. So 2 or 3 months ago, the assumption that even the most bullish assumption you could make as an equity investor or a property investor, credit investor, was that 10-year treasuries, US treasuries, would be trading between, let's say, 1.5% and 3% for the next 3 or 4 years. Now, you have to assume that 10-year treasuries are going to be trading between 0 and 1 or 1.5% for the next 2 or 3 years. And that is a completely different discount rate environment and pricing environment for risk assets. So I think as soon as it becomes clear, if it becomes clear that the fiscal stimulus is working, then I could understand why there would be a very powerful risk-on rally in equities, in commercial property, in credit, maybe even in emerging market currencies. But right now, the probability of that is no more than 50 or 60%. So that's the second time horizon. So basically, I'm bearish in the short term. I'm pretty bullish in the medium term, but I've got to recognize that that is a hope rather than a prediction. And then in the long term, say 3 to 5 years from now, we have to start worrying about inflationary pressures and rising long-term interest rates and steepening yield curves, because it seems obvious to me, and maybe we'll come back to this in greater detail, that the long-term effects of the monetary and fiscal stimulus we're seeing, the combination, the fact that monetary policy is now being subordinated to fiscal policy all over the world, we're no longer in inflation-fighting monetary policy anywhere in the world, plus a number of structural factors that we might go into, produces a much more inflationary global environment, so let's say from the middle of this decade onwards, from 2023, 2024 onwards. I could go on. I think I've already talked for too long. I can't hear.
Daniel, I think you're on mute.
Yes, thank you very much, guys. Still getting used to operate this thing. Thank you very much, Anatole. Let's move on. In this is the first round. A lot of notes here to get back to you. Surely. Andrew, if I'm correct, you were 50% of the time based in Beijing, 50% based in the US for a long time now. So I would like to take this opportunity actually, so to get from 50% local and 100% specialist in China as you are, what is happening as we speak? What you can gauge from this very fresh high frequency indicators on China? How is China is trying to normalize? On China as well, on the one hand, they're relaxing. They started to relax some restriction measures, but on the other hand, a lot of still public health restrictions around the big cities and around the major regions in the country. What we can read from the data and what we expect from this, as Anatole put, Anatole's really bearish with the Q2, the second quarter. What should we expect from Chinese data on the second quarter?
Okay. Yeah, as you said, this we do have Chinese data now from this period of the lockdown, which we don't really have yet for most other major economies. So what we're seeing from, I think, is indeed pretty useful, to give us an idea of how this process works. So it's easier to show some stuff than talk it through. Pull up the my presentation, and let's go to slide 3. So the pattern that we saw, the economy goes into lockdown basically at the end of January, around January 20th, and like activity precedes the cliff. But by the beginning of March, epidemic is under control, and then by the middle of March, it actually had there's no new cases. So the worst of the lockdown measures started to relax in March, and on the official data, you can see that there's actually pretty strong bounce in at least some parts of the economy, particularly in industry, in the industry and investment side. So by the end of March, it looks like, at least for factories, particularly in upstream sectors, they had workers back into their positions, and they were able to find a way to get back to normal operation with some health precautions. What did not bounce back so much was retail sales. This is obviously all of these consumer-facing interactions are much more restricted. And if we could go to the next slide, please. And then if we look at the high frequency data that we've got, so there's a few daily indicators that people are watching. They're little slices of the economy, but still indicative. So property sales in some of the major cities, coal, traffic congestion measure. And we see that after that kind of bounce in March, where the worst of the lockdown was lifted, the improvement in April has been more gradual. It's not this kind of 45-degree slope upward improvement. And if we go to the next slide, which I think this is a fun data series, which one of my colleagues has just unearthed. And so this is some ordering information from a large sample of restaurants in China. So again, you can see that there's pretty substantial improvement in March, a bit more, things have gotten a bit better in April, but the slope of that improvement is much slower. So, what's the reason for that? The obvious reason is that Chinese authorities are still pretty concerned about the coronavirus situation. So they had that landmark of no locally transmitted cases in March. The good news really didn't last. And if we go to the next slide, I'll show you that. So shortly after that, in late March, they started to get some new cases coming in from the rest of the world. And then what was really concerning is that those imported cases started obviously to transmit to other people locally. So again, those red bars that you see in the chart is that of local cases. And that's what they're really worried about, is that these people carrying the virus coming in from abroad and then starting to spread. So you had that kind of first wave of relaxation at the beginning and middle of March, and then actually things started to tighten up again, and then in April, actually in many places there were even more restrictions that were reimposed because the authorities are just taking a hyper cautious approach to all this. So skip just one more, please. This is interesting project one of my colleagues did. So not a totally scientific survey, but she did reach out to various contacts on social media, pretty broad pool of people across the country, of just what they're experiencing in terms of their daily life in China. And what's important to remember here, although Beijing, one part of Beijing, part where the Dragonomics office is, actually is still a high risk area because they've had some imported cases, almost all of the rest of China now is designated a low risk area. But life in a low risk area is very much not back to the pre-coronavirus normal. You still have temperature checks to go into office buildings. You have to record your personal information going in and out of places. There's still restrictions on delivery services. Restaurants, are probably open for dine-in service, but they're not taking full capacity. A lot of tourist sites are still closed. So there's been a return to normal, but only a partial one. And this pattern does have some relevance for what to expect in other countries. Granted, I think the Chinese authorities are taking a very, very cautious approach. And maybe the cost-benefit analysis that governments elsewhere is not going to be the same, but they do face the same kind of issue in that you can control the coronavirus in a particular area, but unless the virus is controlled in all of the areas in which you have exchanges and communication, you can't say completely controlled. So there's always this risk of new outbreaks kind of coming in. So because China's not isolated from the rest of the world, it can't fully relax as long as other countries are still having the same problems.
Perfect. So I'll try here to summarize before moving to João. Okay, Anatole, here for the short term. Let's put the short term as being the second quarter, right? So the Q2, bearish in the short term, and Anatole even highlighted actually in terms of data, the worst is yet to come, and Anatole fears that the next round of data, the second quarter, the data that will be released during the second quarter could even scare us in terms of what we in markets are pricing and what markets anticipating. What I can tell from your view, Andrew, is that somewhat I see you guys on the same page. I mean, in Chinese, they're still struggling to try to normalize and to restart the economy. Authorities are still very worried and very concerned. We have evidence that point to a second wave of outbreaks from COVID-19 spread. So things should be slower than probably, as Anatole put it, the markets would like it. Okay, so João, having been said, I don't know actually if you agree or disagree with the views that were just presented. I don't know if you're more upbeat with the global economic recovery or financial markets reaction. I would love to have your take on that, but especially if this more downbeat or bearish, let me put this way, scenario that we've been highlighting here really materialize in the short term. How do you think it should impact emerging markets, especially, and in emerging market class, how Brazil should be affected in terms of economic activity and in terms of interest rates and asset prices? Thank you very much, João.
Okay, thank you for having me here. Well, I am in the same page as Anatole and Andrew on that front. I mean, I share the same concerns, and I think the market. My impression is that the market, in a certain way, is already prepared for very bad figures in the short term. But I'm really concerned that they might be over optimistic on the recovery. And of course, we're going to have a very rapid recovery in the very early stages of the resumption of activity when we relax the lockdowns. But after that, I think it's going to be much more complicated to proceed. I mean, we're not going to get back to the previous levels of output anytime soon, right? And on that front, I think I'm more concerned that is going to be a very incomplete and non-linear type of recovery after the initial bounce. And I think it was very interesting the point of view of Andrew in the sense that I hear a lot of investors and people talking about the V-shaped recovery of China and how strong it is, etc. And I think what he points out is that even in China, it's very incomplete. And the signs we're getting from the Chinese government is that they are worried and they're trying to come up with new stimulus even now in April, right? So it's a very different narrative from what we hear from some investors. of course, the implications for emerging markets, of course, I mean, they are negative. But in a way, I think I'm also concerned with the fact that, as Andrew was pointing, I mean, it's difficult to get out of the lockdown. It's and to control the disease going forward. It's not like that we have a vaccine already or some kind of very effective treatment, right? The virus is out there. We have the lockdowns. They are effective in really flattening the curve, but it's an ongoing concern after you ease the lockdowns, right? And in all countries, I think this is the case. And of course, in emerging market countries, in most of them at least, I think there's less preparation, there's less planning in terms of how to get back to a new normal in terms of economic activity, in terms of testing, massive testing, contact tracing, all these things that are being done in China extensively, in Korea, and that most developed nations are trying to do right now. So there's one concern with this particular aspect there. The other aspect has to do with the fact that, of course, many emerging market economies, and I think it's more true even in Latin America, I think there were some problems, growth problems that preceded the coronavirus shock. So, I mean, you look at Brazil or Mexico or Chile, growth was a very, very, very disappointing in the past few years. So you already had some let's say, pent-up demand for growth, social demand for that, and of course this huge shock and this, which will bring some growth scars, of course, will create some medium-term pressures as well, right? So the temptation of populism or other more dangerous policies will be with us to deal with long after this initial shock has vanished. So I would think these considerations are something proper to discuss, right? So at the same time, of course, I mean, we've seen, especially in Brazil, I think an evolving response to the shock. Initially, I think it was a very tame response, and then it was beefed up with time, both on the fiscal side and on the monetary side, right? So I think both policies have been playing a larger role, not compared to what's going on in the US or Germany on these large economies. Of course, there's no way to compare. The tools are not here to do that, but I think they have been beefed up. Again, my concern is more on the long term, especially in Brazil, which is already had a fiscal problem, was trying to deal with that. I think we have had some progress in the past few years with the debts, the expenditure ceiling, constitutional reform, the social security reform. All these things are very important to allow Brazil to respond more meaningfully with fiscal relaxation in the short term to this emergency, but it's going to be very, very important to keep fiscal discipline as soon as we have, or to recover fiscal discipline as soon as the worst part of the shock is over. So I'll leave it there, and then we can comment on other points later on.
Yeah. Thank you, João. And I'll totally get back to you, as actually I just to share with everyone, Anatole was asking what's happening in Brazil right now. So I'll bring this question later on, so we can discuss Brazil a little bit specifically on what is happening right now with all this political situation and stuff. But reversing the round now, Andrew, what is your evaluation on the crisis response from authorities? Because on the last big crisis that the world faced, and I'm referring here to the great financial crisis or the global financial crisis back in 2008, Chinese response was something that really brought the whole world back to the surface again. Having this as a reference, how those authorities and policymakers reacted back then, how do you see the reaction right now in this corona crisis? And going forward, will there be any kind of growth target or something that they are really watching to give more or less stimulus and try to fine tune as they always manage to successfully to implement. So how is the crisis response right now going forward? If they need to do more stimulus, what tools are in the toolkit, and what do you think will be the reaction function from Chinese authorities?
Yeah, great question. So obviously the closest comparator to what is happening in the global economy now is the big growth shock in 2008, and Chinese policy response then was totally unprecedented in terms of the scale and scope of the combined fiscal easing. And we were talking at the beginning about the environment for developed countries, so we have both an unprecedented growth shock and an unprecedented policy response. And in China, you don't have an unprecedented policy response. I don't know what the opposite of unprecedented is. I guess it's precedented. So you have an unprecedented growth shock, and then you have a policy response that is not proportionate to what's happening. And I think this has surprised a lot of people, again, because of this very prominent example in our recent economic history of the 2008 response. So what's going on here? So my theory about this is twofold. So one, I think, look at what happened in 2008, this enormous wave of infrastructure spending that went on across the country. In many ways, this was not it was not a centrally planned and designed stimulus, right? It was not that the authorities in Beijing said, we need to open the floodgates and we're going to give a blank check to every city and county government in China to basically build as much as they want. Like, that never happened. No one ever said that. There was no order that went out that said you all have free money to do whatever you want. What happened? That there was it was much more of a decentralized response, and in a way, as kind of an abdication of control by the center, which they said, well, we need to do a bunch of stuff on growth. We need everybody to pitch in, and we're just not going to look too closely at how the financing and how these decisions all get made. We're just going to sort of point people in the right direction and hope everyone does what's needed. And the aftermath of that, of course, was this huge buildup in debt, which has been worrying the Chinese authorities for a long time. And what they've been doing over the past few years is really trying to re-centralize control over all of these local authorities, so that they can't just spend as much as they want on local infrastructure projects anytime they want. And that's been a project of many years, and a very difficult one to kind of rebuild after this huge floodgate of money went through the system. So you've really, in China today, got an institutional structure that's totally different than the one that they had in place to tackle the 2008 crisis. It's much more centralized, it's much more controlled, and because of that, I think you're very unlikely to see anything like the scale of the 2008 crisis, because the scale of the 2008 crisis was not something that was centrally planned and decided in advance. It just sort of happened as a result of all of these, of the interaction of all of these incentives with the decentralized system. So now the system is much less decentralized, and so the scale of the stimulus is going to be, what the central authorities decide it's going to be. It's not just going to, it kind of emerge randomly from the lower levels. So that's part of it. And the other part of it, I think, is more to do with the kind of the intellectual environment that the decision makers in China are operating in. So a lot of the people who in China who are in power now in the central bank and in various economic policy making bodies, for them, this dealing with the aftermath of the 2008 crisis has been the defining part of their career. So all of the major economic issues in China, like over the last 10 years, have had to do with the fallout from the 2008 crisis. So what do we do about debt? How do we handle the fragility of the financial system? How do we reimpose fiscal discipline? So for a lot of these people, the overriding lesson that they learned from 2008 was that we did too much. and we've been paying the price for it ever since. And the distortions and the problems in China's economy that everyone knows about were all exacerbated by this response. So with the crisis hit, we overreacted, and we've paid a big cost for it. So their reaction function, I would say, is the opposite really of the U.S. in 2008. So in the U.S. in 2008, they underreacted, and everyone who was in position of power in 2008 realizes that. Right? Said we did too little. We should have done more. We were always behind the curve. So then when the next comes around, lesson that they learn, we must be ahead of the curve. We can overreact first and then dial it back later. That's much better than underreacting, because if you underreact, you can't. It's very difficult to ratchet it up later. In China, they've learned the opposite lesson. We overreacted. So the better way to do it is to ratchet up our response, like over time, in a more controlled and measured way, and that way we won't have these other set of problems to deal with. So that's why, relative to what's happened in the developed economies, especially, China's been what I would say just in the curve. I wouldn't say they've been passive, that they're not doing anything. That's not at all what I mean. They've been, they're very engaged and working hard to try to figure out what the right response is. But the way that they're tackling this is not to do the shock and awe approach, and push everything out all at once, but much more to kind of ratchet up things over time.
Okay.
So on your question about what comes next, maybe we could go to the slides here. So if you could pull up slide 10 on my presentation. So this is just a kind of an illustration, something that I put together on my own of kind of the the 6 stages of grief, if you like, sort of the 6 stages of the coronavirus response. So kind of what China has gone through. So they've gone through an initial stage where they were pretty confident that after the lockdown, things would just kind of bounce back to normal. So they really didn't need to do too much in terms of active stimulus. And then that evolved as they saw the spread of the coronavirus into the rest of the world. By March, they realized, okay, this is not just a situation where we lock things down and then open things back up. We have a hit to growth for a couple months, but things bounce back to normal. But it's this evolving shock to global demand. So we have to not just get our own economy back to work, but we have to start compensating for this huge hit to global demand. And that when I think you saw a kind of a more aggressive policy response come up. So you've seen more interest rate cuts, and then a stepped up infrastructure spending, and more willingness to use the fiscal deficit. So over the last couple of weeks, we've had a pretty interesting kind of shift in the rhetoric. And this, I think, signals that again, that they've gone into a new stage, which is not just about, we have to, offset this hit to external demand, but that we need to support the economy for an extended period of time, because this is going to be ugly, right? So again, the thinking has evolved from we need to, try to, get a quick bounce out of the recovery to being, there's not going to be a bounce. There's not even a point in trying to engineer one. So we need to make sure that the economy kind of operates healthily, and that we prevent major damage to it, because this is going to be an extended process of the global economy getting back to normal. So that, I think, mean that we're going to see a lot more fiscal support from China. So far the announced fiscal stimulus is pretty small. The IMF estimate 2.5% of GDP, which again is it's not nothing, but it's peanuts compared to what the U.S. and some of the other major developed markets are doing. And I think the next stage for China is to probably roll out not so much stimulus programs, but more support programs for the population. So expanded social welfare benefits. They're talking about widening eligibility for unemployment benefits, raising relief payments for low-income workers, probably a lot more support for small and medium enterprises. So more lifeline type measures than stimulus measures. So I think that's kind of the next stage that's evolved.
Okay.
But again, I think it's interesting that in a lot of these type of relief support measures were in the first of the response, and not if China is only kind of getting to that type of response.
Mm-hmm. Interesting. I'll move now to Anatole, and having the financial crisis, the great financial crisis in 08, and how Chinese respond, as we just saw, as Andrew put it, I would summarize that in, okay, so don't look to China to save us this time. Okay, yeah. So this have serious implications going forward, especially for commodities. And so actually you were talking about how, financial assets are really rallying even more aggressive than you would anticipate. But I think there is one asset price that totally disagree with that is really feeling the burden and really feeling the pinch, which is oil.
Yeah.
Anatole, I would love to have your take on oil prices, what is happening and how this can affect even the real side of the economy and financial prices and even monetary response around the world.
Well, so first of all, I have a long-term structural take, if you like, on oil prices, and then about what's going on. The structural take, if you go to slide 10, page 10 in my slide deck, it illustrates that. I think what we've got to recognize, and what a lot of people in the oil industry did not recognize until a few months ago, is that since 2014, since essentially the breakdown of the Saudi willingness of the OPEC cartel, because Saudi was no longer willing from 2014 onwards to be the so-called swing producer that kept cutting its output whenever oil prices fell. Once Saudi abandoned that position as a swing producer, oil started trading just like an ordinary commodity, like copper or iron ore or coal. It was no longer in a monopoly pricing environment. And so I think structurally, if we look over the last 50, 60 years, which is what I do in this chart, what I think is pretty clear is that there have been about 30 out of the last 60 years in which oil has operated like a monopoly pricing environment, like a cartel. Those are the red periods between 1974 and 1984, and again from 2005 to 2014. And then there have been about 25 or 30 years when oil has operated just like a commodity, like iron ore or cocoa or copper or whatever, where the price has been set, the top of the price has been the marginal production cost, the production cost of the marginal producers, of the highest cost producers, and the bottom is the production cost of the lowest cost producers. And that's why I think there has been a sort of ceiling on oil of $55, $60, because that's the cost of the shale producers in the US, the marginal cost, if you take into account everything, their financing costs and so on. So whenever oil went above that, it couldn't really last. What we're seeing now is the test of the bottom of that range. And the fact is that the marginal cost of the low-cost producers, Saudi Arabia, Kuwait, Russia, is of the order of $10 a barrel, or maybe even lower, $8 a barrel. Brazil, unfortunately, with the subsalt under deep sea oil, is much closer to the shale producers. So what we're seeing is a test of the low. And because of the enormous abundance of this cheap oil, because the Saudis, Kuwait, even Iraq have been holding back production, there is effectively, certainly in this weak demand environment, an unlimited supply of this very cheap oil. So I find it very hard to imagine how the oil price can get back up even into the $30 to $40 range, at least until there is a very strong, unless there is a very strong recovery in the world economy from next year onwards, which could happen, but as I say, that's at best a 50 or 60% chance. So what that means is that the oil production sector of the world economy is now financially very unstable. And that, I think, has big implications, and in the short term, unfortunately, negative implications, even for the US economy, where investment in the shale sector has been the biggest, by far the biggest driving force of real capital investment in the US economy. And of course, for the Middle East and a number of emerging economies at a time when they're already financially vulnerable because of the collapse in demand and the strong dollar and so on. So at least in the short term, the next 3 to 6 months, I think the low oil price is unfortunately a negative factor for the world economy. By next year, if demand stabilizes with all this fiscal expansion, then actually cheap oil could be a positive factor, especially for oil importing emerging markets. But it's, in my view, much too early to take that trade. Can't hear you, João. Can't hear you, Daniel.
Sorry, I did it again.
Oh,
yeah. Okay. So I'm moving. Thank you very much, Anatole. I'm moving back to João, but before a really quick stop at Andrew, since we were talking about commodities, iron ore. So how you see the Chinese recovering in this demand perspective? What do you see iron ore prices in this short midterm?
Yeah, so actually, we tend to look more at the steel price within China, since that's a key variable for the Chinese economy, and really reflects the state of construction. And of course, the iron ore price is somewhat a derivative of that. And the interesting thing there is that actually the steel price has come down, as you might expect, but it's only came down about 10% or so from its peak. And it's actually stabilized quite a bit by the middle of April. And that, I think, is a sign that while the economy is being relatively slow to get out of this lockdown mode, the leading sectors coming out of that are, in fact, the construction and heavy industry. The least affected by all of these lockdown measures, and they're the most direct beneficiaries of the stimulus policies that have been taken. So the traditional Chinese stimulus response, of course, is infrastructure spending, and that the funding for that has been ramped up pretty substantially already at the beginning of the year. And so the local governments had been raising money for that, through March, and as lockdown measures lifted towards the end of March, a lot of those projects are now able to, physically get back to work. And the central government, we don't have a number yet for, for how much debt funding they're going to allocate for these infrastructure projects this year, but the general expectation would be pretty substantial. They've already approved, 2.3 trillion RMB for this year, which is more than they did last year. And most people think it's going to be, over 3 trillion, maybe 4 trillion for the full year. So that's a pretty substantial bump, and you're likely to see infrastructure, spending accelerate, more than it has for the last couple of years, certainly. So probably up to 10% or more. And housing actually does not look too bad either. So the various indicators of housing market sentiment and prices, they sort of wobbled during the lockdown, but are not too bad. And we have had interest rate cuts, and while the government, makes a big deal out of this kind of conservative rhetoric they have around the housing sector, saying, we want to build houses for people to live in, not for people to speculate on. in actual fact, policy for the housing market has gotten easier. Mortgages are cheaper, and that is going to stimulate demand. So I think the market is looking at that and saying, this is not going to be a huge rebound in housing sales, but we've got some stimulus coming through, certainly more than we thought we were going to get before all this happened, and you've got a pretty substantial bump from infrastructure spending. So on the margin, it looks like that part of the economy is going to be getting better over time pretty clearly. So that I think that's supportive for prices.
Thank you very much, Andrew. João, I will start to address the end of this conversation with you with the topic Brazil. So what we could see actually, so this is a very challenging crisis, and the road ahead is very challenging to say the least. And the last time that financial markets in Brazil got hit this bad in the early 2000s, and with 2008, the aftermath, we could count on Chinese pent-up demand going forward, which appears that is not, this time is really different. China will not save us this time. And so how do you see this global environment that we discussed in here tonight, and with the specific domestic issues that Brazil is presenting in the political side? So how do you see Brazil positioned among asset classes and among its peers to behave and to be attractive or not for global asset allocators as we start to move out of this crisis?
Okay, I think that's a very interesting question. First, I'd like to point out, I mean, there are very important differences when you compare this crisis to previous crisis. The way not only Brazil, but many other emerging markets are, in the sense that we enter this crisis on the one hand with much higher FX reserves than in previous crises. So even though the currencies have been depreciating, I think the impact is very different, and the reasons are to a certain extent different. The fiscal implications of this depreciation are very different from the past. Like if you remember the early 2000s, when Brazil was not a net creditor in foreign currency. I mean, currency depreciations had a negative impact on the fiscal dynamics. This is the opposite right now, so this is another difference. We don't have that much a problem of private sector indebtedness in foreign currency as well. Also recalling, for example, 2008, we had some issues there, some financial stability issues with this. So there are some important differences. Inflation expectations are anchored. Inflation is very low. This shock, even though the currency has depreciated a lot, you have also a very deflationary environment, especially coming from oil and some other commodities. So this is pretty much compensating for the effects in the short term. So this has allowed many emerging economies actually to cut interest rates, and it has been the case in Brazil, and there's more to come according to the signs of the central bank. So there are some important differences. But at the same time, of course, what you point out is that, of course, we cannot count on China bailing out emerging economies with a massive stimulus. There isn't a stimulus going on, and there's more to come, as Andrew pointed out, but it's not something massive, something compared to 2008. So I think, of course, as this new Chinese stimulus comes in effect, it will eventually be a positive at the margin for emerging assets and for Brazilian assets. As the global trade actually bottoms and starts to pick up, it will be positive for us. But there's not going to be a magic bullet in terms of providing like a big growth stimulus. Of course, monetary policy is more stimulative now. You have some space for fiscal stimulus. The government is using it. But as I said, I don't see like a big space for another fiscal stimulus next year. I think part of the discussion that is going on in Brazil and within the government is exactly this: how we're going to get out of this and how we're going to actually have a more meaningful growth after the shock has vanished. And there's no easy answer, right? I think there are some proposals that we should have something more of an active fiscal policy, public investment, have a more active role there. But the issue is Brazil had already a severe problem in the fiscal side before this crisis. We're going to get out of this crisis with public debt to GDP over 90%. Right, and it's going to be very, very important to continue to give signals that we, as a country, remain committed to fiscal discipline over the medium term. Right. So, in the sense, I think that resuming fiscal reforms, trying to contain the growth of mandatory public spending is very, very important. Even to build up over time some room for public investment. Right. But we have first to show the commitment to this containment of this historic problem we have with growth, autonomous growth of mandatory spending in Brazil, right?
So to get it, a straightforward question. So against this global backdrop and among its emerging market peers, would you bet that Brazil would be in the next, let's put it until the end of this year, would you bet that Brazil will be an outperformer, a market performer, or an underperformer in this recovery?
Right. I think in the end, we're going to be probably a market performer. In a sense, I mean, most of these risks are already priced in. We're speaking about that, but Brazil has been a laggard, really. You look at the currency, you look at what happened to the equity markets. Brazil has been punished for these uncertainties, so it's not something completely new, right? But on the other hand, as I pointed out, I don't think we are tied to the situation. I think there are ways forward, and I think that at the margin there are some more encouraging signs, slightly more encouraging signs on that front, right?
Okay, thank you very much, João. So I'll throw the last question to Gavekal, so to Anatole and to Andrew. I consider myself a long-time reader of Gavekal, and I'm proud of that. It's a really, really rich material. And this analogy is a classic. For Gavekal readers that are watching us right now, they will feel me. The dynamite fishing. Okay, so always when you have this market shock, and this outstanding market shock that we observed back in March, I mean, in terms of volatility, in terms of the aggressiveness of the sell-off that we saw in March. So usually the biggest impact, it takes time to develop and to come up to the surface. So the analogy goes, when an explosion, an underwater explosion goes, so first you see the small fishes coming to the surface. After a while, you'll start to see the mid fish. And then later on, it comes the big whale. So based on this market shock that we had last month, Andrew, what do you fear could be a big whale to pop down the road?
Yeah, for China, I'm not sure that there's necessarily a whale that's going to surface. I mean, if we're thinking in terms of corporates or particular institutions, because all of the big institutions, all the big companies in China are state-owned and have that kind of backing, so they're not exposed to this volatility and the risks in the same way as kind of companies are. For me, I think the thing that I'm worried about for China more is not so much that there's a whale, but that there's a lot of minnows. And you say, first we see kind of the minnows coming up to the surface. Well, in China, we're actually not really seeing that because of, the data on what happens to unemployed people, the data on what happened to small and medium enterprises are so poor that we're not really seeing it. And we know that the damage is out there. We know that the damage is very substantial, but there's hardly any public information, public data about this. And so that kind of allows the public narrative, as it's shaped by the government, to kind of skate over these problems. But that doesn't mean that they're not real. And I think they are very serious. So there are estimates, credible estimates out there that China is going to lose 10, 20 million, maybe even more jobs this year. Meanwhile, the official unemployment figures have shown an increase of maybe 4 million. So there's a big gap in the order of magnitude we're talking about here. I think we're going to see a loss of large numbers of small businesses. Of course, it's not an issue just for China. It's happening everywhere. But I think but the division in China between the kind of small private sector companies who don't have this access to state protection and the large state-owned companies is it's a much starker, more serious division than you see in other economies. So I think you're going to see a lot of failures of small businesses. You're probably going to see a lot of failures of small banks. China's an incredibly overbanked country with thousands of tiny financial institutions. A lot of them were in pretty bad straits before this happened. So I think we're going to lose a lot of those. So I think a lot of minnows, I guess, is my answer.
Okay, thank you, Andrew. So before I really threw the last question to Anatole, just a reminder to everyone. So this presentation from Anatole and Andrew will be available. Just let us know. So probably we're gonna post it on our website. So feel free to access it then. They are pretty insightful. So this is my invitation for you all to access the presentation that we're gonna post it. Anatole, do you final question? Do you fear any big whale coming to the surface down the road, especially in the oil sector? Anatole, I'm afraid you're mute.
Yeah, have you unmuted me? Okay. Yeah, I'm glad you asked Andrew the question first because it gave me some time to think about it. And actually, I want to propose 3 or possibly 4 possible whales. And each one of these is relatively small probability, but it's a tail risk, it's a huge risk. So first of all, in the oil sector, I think the really big whale would not be an oil company. Of course, there'll be lots of destruction in Texas and among the shale producers and so on. But those are what we call not the minnows, but if you like the dolphins, the small sharks from the West. The real whale could be Saudi Arabia in this sense. The Saudi currency peg is one of the few remaining fixed dollar pegs in the world. It's basically the Saudi peg and the Hong Kong peg. The Hong Kong peg is safe because there's nothing wrong with Hong Kong and it's ultimately protected by China, I think. The Saudi peg is is I think now in very great danger. Saudi reserves are already falling, rapidly, even during the period of $60, $70 oil prices. With oil prices at $10, $20, even $30, Saudi cannot finance its imports and its trade deficits, which are running, even with oil price at $50, we're running at roughly 10% of GDP. So I think the Saudi currency peg could be a whale. And the reason it would be a whale is that if the Saudi currency peg breaks, it's possible that the whole Saudi regime breaks. So that, I think, would be a very big one that's worth. The other one, of course, that would be even bigger, which my colleague Charles Gav, my co-founder of Gavekal, Gav and Kaletsky, that's what it is, Charles Gav believes in, is the euro. And I think the danger to the euro now is greater than it was in 2012 and 13. Because in 2012-13, the danger was coming from small countries, from Ireland, Portugal, Greece, and even more importantly, it was coming from the financial markets. And the ECB, when it decided to do whatever it can, the central bank in the short run can always beat the financial markets. They can always stop bond speculation and currency speculation. The danger now is coming from one of the largest countries, Italy, and the next one after that, Spain. So this is not Greece, this is not Portugal, this is core Europe. And even more importantly, it's not coming from the financial pressure, it's coming from the political pressure. If you have a Brexit type of political movement developing in Italy, and it might be called Quitaly or Italy or whatever, if there is a political dynamic in Italy against EU membership, like we saw in Britain 3 years ago, there is nothing that the ECB or anybody can do with money to stop that. And therefore, unless we get some kind of very significant transfer and risk-sharing mechanism established in Europe in the next 6 months, involving not hundreds of billions, but a minimum of 1 trillion, probably 1 to 2 trillion euros, there could be a real threat to the euro. Now, I think that that mechanism will come about, and therefore the euro won't break out. But if by the end of the year you don't have some kind of risk sharing in the order of 1 to 2 trillion euros, the euro could be the big bet. And the third one that I'd like to mention is in the corporate sector, SoftBank. SoftBank is also linked with Saudi. A very large amount of the Vision Fund is financed by the Saudi government, who can no longer continue financing it. And if you think of SoftBank's biggest single investment, WeWork, if there is one clear corporate victim of what is going on, it is a company that was already on the brink of bankruptcy, the largest commercial landlord in New York and London, with leases that have expiry periods of 1 month on the asset side, and on the liability side, it has signed long-term leases with property owners of 20 years plus. So this is an incredibly unstable financial situation. All their short-term leases are being cancelled. SoftBank itself has an extremely complicated and obscure, highly leveraged financial structure, very reminiscent of the financial structures, you know, going into 2007 and 2008. And the reason why SoftBank would be a whale is because potentially it brings down with it the entire venture capital industry of the United States, because the prices that have been established for loss-making venture capital companies like Uber, Netflix, Tesla are to a large extent established by what SoftBank was willing to pay for it. So that would be another whale in my view.
That was really, really insightful, Anatole. Thank you very much. So, gentlemen, to everyone that is watching, on behalf of BTG Pactual Digital, thank you very much for your time. Andrew, Batson, Anatole, and João, thank you very much for having the time to make this possible. I think it was a very productive conversation with a lot of insights, and I thank you all for that. I wish you all stay safe and have a great night, guys. Bye-bye.
Thank you. Bye-bye.
Bye-bye. Thank you.
Bye-bye.